Jana discovered something that should really terrify every crypto investor.
If you get audited, who do you go to?
The industry is built on a fundamentally flawed foundation.
Because if the IRS says, this is what you owe us, it is on you to prove that they are wrong.
The existing solutions just aren't cutting it.
Well, that's a big issue, a very big issue. So I built something that very much focuses on educating the clients.
A lot of people don't realize the level of data that is on chain.
Have you ever tried calling Coinbase? You ever tried calling Kraken? Good luck. Well, actually, it's easier to get a hold of the IRS than it is to call Coinbase. No, you can manipulate data. I can make it look like I made $15 million last year.
They're allowing people to create their own reality.
Don't do it. They have a program. They run it through. They tell them if it was manipulated. Don't do it. And again, I didn't do this to make money. I tried to give this away for free multiple times. People didn't care. One differentiating factor can cost you $50,000 to $100,000 in additional capital gain.
And after listening to this, has decided I'm panicking. What's the right thing that they should do right away?
My gut feeling is,
welcome to Fintech Confidential, bringing you the people, tech, and companies that change how you pay and get paid. You're building a fintech product. You want to offer digital assets, but wallets? That's the hard part. Security, compliance, key orchestration, blockchain integration. That's why fintechs, payment platforms, and custodians choose Dfns. They provide wallets as a service that's API first, multi-chain by design, and secured with MPC. No single point of failure. So you can launch across over 50 blockchains, automate policy controls, and stay audit ready without managing private keys. Stripe's Bridge powers crypto payments through Dfns. MoonPay scales wallets securely with Dfns. Sphere grew without compromising on control or compliance. Even major FIs like Fidelity, ABN AMRO, as well as custodians like Zodia and Tungsten trust Dfns to power their on-chain infrastructure. Developer ready, compliance approved, production grade from day one. If you're building in payments, exchanges, OTC desks, market makers, or DeFi, Dfns wallets work the way you need them to. Request your demo at fintechconfidential.com/DFNS. Dfns, secure wallets built right. Welcome to Web3 with FTC by Fintech Confidential. If you've been asking how blockchain, crypto, AI, or even quantum computing fits into your business strategy, this is built for you. We talk with the builders and decision makers who are doing the work. You'll hear smart conversations, straight insights, and no filter. Whether you're a founder, exec, or just trying to stay ahead, this is where real talk meets real tech. I'm your host, Ted Huff, and today's guest is Janna Scott, founder and CEO at DeFi Tax. So let's go ahead and get started. Jana, welcome to Web3 with FTC. I am genuinely excited to have you here today.
well, thank you for having me. I'm excited as well.
So for those of you who don't know Jana, she brings a perspective to crypto taxation that literally I've heard no one else in the industry talk about. With her background as an IRS Enrolled Agent and experience working with the federal government agencies, including the IRS itself, Jana discovered something that should really terrify every crypto investor. The entire crypto tax software, the industry is built on a fundamentally flawed foundation. And she found this out after conducting forensic level audits of over 14 of the major platforms and 53 of the so-called tax expert firms. She uncovered variances that ranged anywhere from 35% or even higher between these platforms on identical transaction data. Not only that, but her peer-reviewed research, now published in tax notes, actually stopped IRS crypto audits for a couple years, over a couple years. And because she could prove that their methodologies were creating chaos, DeFi Tax isn't just another tax platform. Really, it was really cool to listen to Jana talk about, like, this is really the first audit-ready solution built through direct collaboration with the IRS, the SEC, and others. And it's designed to eliminate the data manipulation vulnerabilities that make every other platform inadmissible in actual audits. So, Jana, I've been honest with you. I've been honest with the audience I've been in this since 2012 and have had some absolute nightmares when it comes to tax preparation and my involvement in crypto. When you and I sat down earlier and talked about it, honestly, it was the first time that I talked to someone in the crypto tax space where I didn't feel like I needed to be an expert in taxation and crypto at the same time to really understand what was going on, which brings me to what I want to dig into first. Jana, most entrepreneurs have this moment where they realize that they need to build something because the existing solutions just aren't cutting it. But your story, it's a little bit different. So you literally had inside knowledge of how the IRS was working and around all these different things. Do me a favor, take me back to the beginning. What was your path into the tax world? And what was the moment you realized that crypto tax and the industry had a massive systematic problem?
Yeah, it's been a wild ride. Not my journey into tax and accounting. That's numbers just always made sense to me my whole life. So when I went into accounting about 16, 17 years ago, it was a natural progression just because looking at financial statements, looking at tax returns, it just came naturally to me, the research behind it. And as you mentioned, while I worked in public accounting for private companies, eventually I worked my way up through working for the government as a tax specialist, financial analyst, and then financial consultant with various agencies. In 21, I decided the government just isn't for me, multiple various reasons. It wasn't. I call it the dark and the light side. So I went back to the light side and I went and I started my own accounting firm and tax firm, financial advisory firm. After working for multiple firms throughout the country and finding that there was a lot of lack of advice or care about their clients. And so I built something that very much focuses on educating the clients. I don't just tell them, you believe me, ABC, this is what you have to do. I explain to them, I show them the codes. I want to educate them. I want them to understand their finances better than I do. And during that time, I had a client approach me end of 21, beginning of 22, said, I have a lot of crypto. How do I report it? I had crypto as well. And for some odd reason, I've never crossed my mind. So I was like, whoops. And that's when I went down the rabbit hole. I had this little exchange that had about 300 transactions between 17 and 21 at that point. And I signed up for all the products I could find. Yay, Google. And I signed up. I ran my little tiny exchange through it. And I don't know what I was expecting. I just wanted to see what the outcomes were. I think I sat in front of my computer after the first three, and I said, what? Because 1 + 1 is 2. I didn't get 1 + 1 is 2. I get 1 + 1 is 592, and 1 + 1 is 375, and 1 + 1 is -260. I did not get any clean outcome for any of the years. And if you consider that each year maybe had 40, 50 transactions that were very straightforward buys, sells, and trades, nothing crazy, no NFTs, nothing too complicated. It was very concerning that all these products that at that time were already valued at a few $1 billion did not get their algorithms right. So that's how I got started. And listen, I did not plan on building anything. I just got my OCD, got a little bit ahead of me. And for a year, I went down the rabbit hole of figuring out what these products are doing wrong and how to do it right. Based on my knowledge of the IRS codes, based on my knowledge of publications regarding crypto, and just the basics. So that is kind of how I got into it.
What was it like working inside government agencies and watching this industry from the inside?
For me, my issue with government agencies, and this is a me problem because that's just who I am, it is too compartmentalized. I like to know why things happen and how things fit together. I would be the kid that takes the toaster apart to figure out how it works. Doesn't mean I could put it back together. But working for the government agencies, the biggest issues were that they didn't talk with one another. The agencies, but not even agency to agency, but the agencies internally didn't communicate with one another. Departments internally didn't communicate with one another. when I was a tax specialist, one of the issues I came across is they were different divisions within my unit. Everybody had a different job. I was tasked with one portion of fixing an issue for the taxpayer, but I couldn't because I had to wait on other divisions. So I went ahead and that was still when we were in office. I walked around to all the divisions and I learned everybody else's job to understand how to fix the problem without waiting 6, 7, 8, 10 weeks for a solution. And I actually got in trouble. I got called to the director's office and I was told, no, because you get metrics and I finished all of my metrics. You had a quarter to finish your metrics. I did it all within 4 or 5 weeks. And they asked, how did you cheat? I'm like, I did it. Here's the SOPs I wrote up that actually helped finish the products and resolve the issues the taxpayers have within minutes. Obviously, that wasn't shared with anybody else in the units in order to do this. But yeah, I had to justify why I was doing a good job. So I moved on, and that was the same thing in every department, very compartmentalized, don't talk to one another. The IRS is the same way. The 1040 division doesn't talk to the 1065 division. The 1040 division regarding donations doesn't talk to the 1040 division that handles W-2s, which it should be. That should be communications. And so that was one of my biggest issues, that it is a lot of hurry up and wait. And I do hurry up and I don't wait, which is why the real world works a little bit better for me when it comes to putting things into motion.
So one of the things that you and I talked about in our last conversation is one of the major realizations that there's a big problem was back in 2021 when the thousands of John Doe letters went out. Like, help us understand what that realization was like for you when you're like, holy crap.
Yeah.
Just sending these out, just send them out.
So I didn't come really across from that because I didn't look much into it until beginning of 22. But in 21, the Justice Department basically put out, and it's easy to find online, they allowed the IRS to send out 1,000 John Doe summonses to any exchange and product that uses KYC, which means Coinbase, Kraken, Robinhood, et cetera, et cetera. But it also means on the decentralized wallets such as MetaMask, if you use anything like MoonPay, if you use anything other than peer-to-peer to purchase crypto on anything decentralized, there's a key KYC component to it. So all of those products receive letters from the IRS saying, hey, give us the info of the US taxpayers that have a KYC. Now, they didn't tell them how much. They didn't tell them how much they bought or when they last bought or if they sold. They just told them these people had crypto. About 2 months ago, actually, the IRS received the third round of responses. So since 21, they have received three responses, meaning, not meaning from from 3 exchanges. It means they received a response because they sent out 3 waves. And so they received updates, like let's say they sent, and Coinbase did try to fight it. To their credit, Coinbase did try to fight those, but ultimately everybody gave out the data. So now the IRS knows who the US taxpayers are, who bought the crypto, who held crypto. Again, they don't know if you bought it, held it, and never sold it. They have no idea. They just know you had it. And now ultimately, in their logic, they're going to look at it and say, okay, Janna Scott, you had your income last year, I don't know, what's $1 million? I wish, but let's just say your income was $1 million on your tax return. And it says that you bought crypto. Now, considering you have that much money, you have a lot of money to put into crypto. So we're going to guess that we should audit you first because you probably have the most crypto and you might have the most gains that you didn't report. So let's audit you. Doesn't, I could have bought $200. I could have had 200 of gains. I could have had 200,000 of gains. They don't know, but they're going to audit me. And that's the issue, right? That's an issue because when we, as you mentioned, I audited these products and we'll go into why they're useless. Even if their math would be right, they would be useless. But we also went and audited 53 so-called CPA tax accounting law firms that say that they're crypto tax experts. And we paid them, we gave them our data. And even those people could not come back with the right data. And I can go into why as well. Now, the concern is if you get audited, who do you go to? Because if the IRS says, this is what you owe us, it is on you to prove that they are wrong. It is not on them to prove that they are right. You have to prove them wrong. Now, how do you do this when Nobody can justify, you can just come up with a number, but they're going to say, look, we did the math. This is the number. Tell us why we're wrong. And that's one of the issues that we've come across in 22, because audits were ongoing in 22, 23, until we met with them. John dollars are still going to be used. They're not going to expire, and they're going to keep getting data of people who've touched any of the KYC exchanges. And it doesn't matter if you transferred it to your cold wallet or ledger or the peer-to-peer, whatever you did. If there's any footprint on a KYC exchange, the IRS is going to know. And I have a love-hate relationship with Chainalysis. I think what they've built is amazing, and they're amazing at tracing, but they're also helping the IRS seize assets. So that's my love-hate relationship right there.
So it was interesting as you talked about your relationship walking around the buildings and talking to the different departments. And I mean, that unique vantage point not only gave you an understanding of how the system works, but how the data moves around everything. But, you also started looking at, like you mentioned, the tax platforms and the crypto experts that everybody uses for the most part. Mm-hmm. I want you to dive in a little bit deeper, and let's start with the forensics piece of it, right? So when you audited these 14 crypto tax platforms and the 50 plus law firms that provide and auditing firms that provide this functionality, help us understand like what the methodology was and what did you find that made you realize that all of these systems and providers really are built on quicksand?
I mean, initially, listen, I remember being at a loss. I remember sitting in front of my computer until 3 a.m. or waking up at 2 a.m. going, ooh, this is something I could try. I mean, it was exhausting because I did not really know where to start either. So I began with taking my little testing, exchange and doing, so every product did it differently. Most of them used API or OAuth2. Some wanted CSV files to be uploaded, which then I actually found out CSV files are completely useless because they're missing a lot of data. So those I could already dismiss because I just from the CSV file alone, I knew my set of data. I knew what I've done, and I saw a lot of missing components. So what I did, I took all the ones that were feasible because they actually did the import from the blockchain, and I downloaded their CSV files because they allow you to pull their data in CSV files. So I did, and I went through line by line. And then I said, well, I need to make sure that they even have the right data. So I went I went to build an API to pull my own data, raw data from the blockchain, unfiltered by any program. So I went and got my own raw data, and I sat in front of it and I was like, oh my God, there's so much on it. So I needed to figure out how to organize it correctly, right?
It's so funny you say that because a lot of people don't realize the level of data that is on chain.
Oh, the fact it's like 20 different columns and then, hundreds of rows. And some of the columns you don't even need, completely useless for the tax calculations. And so that was my first step. I had to figure out what was essential for me to know for my tax calculations. And by doing the trial and error on my end and knowing how the IRS handles stocks, how the IRS handles any type of other assets, asset sales or income assets, that's kind of how I went about it. And doesn't mean I got it right away. Trust me, I have way too many spreadsheets. And I organized it, and I figured out how to organize it, and I figured out what even on the blockchain were missing components that the other programs missed as well, which is if you trade in and you trade out, you should have 2 rows and not just one, because something left your wallet and now or exchange and something else came in, instead of having it in one column and just not properly accounting for it or accounting for it on the back end without actually seeing the data. So I organized a lot, and then I went ahead and I gave it a try with my own calculations. And trust me, even just having 300 transactions, it was not fun. Now I can do it in my sleep, but back then it wasn't fun. So it took me a couple months to actually figure out how to do it right. And I used their products and the CSV files, and I compared and I checked, okay, why do they have this number for this taxable event? Why do I have this? And I always went into it that I'm wrong and they're right. Because quite frankly, who was I? I don't know much about blockchain technology or, I know how to trade crypto. I know what happens. I know a smart contract. I understand all that. But they're billion-dollar companies, so I have other resources. So why, I went into it saying, why would I be right? Why, I'm assuming I'm wrong and they're right. And then I tried to prove my point. And, just like research. And I figured out why I was right and why they were wrong. And granted, listen, not every single calculations for every single taxable event, they were wrong. The majority was wrong, but not all of them. So we have common denominators there. So I just have to figure out why mine was different. And I figured it out really quickly. It's because they incorrectly categorized transactions, or because of the way they had the algorithm set and the back end, it just didn't come over. It was discarded.
Yeah.
Or they had too much data that was inconsequential. Because, for example, Kraken, if you pull the API report, it gives you a lot of something called auto allocate. And it looks like it is all it is. It's for Kraken, Stack, and Ledger, an entry. It has nothing to do with your tax calculations. So those should be completely ignored, but you won't know that unless you actually test a bit yourself to see what it was and what happened. So that's what I did. I went very deep into, and I probably have a little bit of crypto on every single wallet and exchange that I could access as a U.S. citizen, because a lot of them are restricted to U.S. citizens at this point. But I probably have a little bit of crypto on all of them. Now, I have a team who helped me with that. But we ran test transactions to everything and then pulled the API and then compared it and made sure that the API actually pushed through the right data. What do we have to add? What do we have to subtract? Why is this coming over in this way? And then we build rules around it, because every single public or private blockchain gives up a different set of data with different names for the type of transactions. And that's what I think these products forgot to do. Plus, then they're wrong on some calculations, and that's something we can go in deeper, but that might take a little longer.
So before we dive into the calculation side of the house, because I do want to ask that question, but one of the things that you and I talked about also is that a lot of times, if I move my asset from Coinbase to Kraken, a lot of times, just because I'm moving it from one wallet to another, that's sometimes viewed as a taxable event. Help me understand that.
So on these tax platforms, right, if you connect both of those, they're pretty good at matching it and making sure that it's technically not a taxable event. However, and this is actually in one of our press releases that we had at the beginning of the year, right before President Trump went ahead and signed that no 1099 DAs are supposed to be issued, which I think it's going to come back. But that is one of the issues. So imagine you're Coinbase and you're on Coinbase and you bought something for $2,000 and it's now worth $10,000, and you say, woohoo, but I want to send it to my Kraken because I have other things I would like to do on Kraken that Coinbase doesn't do. Great. However, how is Coinbase supposed to know that you send it to your own personal Kraken? Coinbase and Kraken don't communicate. They're competitors. So if Coinbase now has to generate your taxable events or a 1099 DA, they're going to say, hey, look, he bought it for $2,000. It left his wallet at $10,000. So he had $8,000 worth of gain. Cool. Let's report this. Not right. But now the problem is, under IRS codes, if you receive something, it's considered income. So now Kraken says, look at that. He got $10,000 worth of whatever crypto it is. Let's report this as income. And that's why I was so concerned about the 1099 DAs. Now, we have a break from it for now. Who knows if it's going to get implemented again, especially with the new regulations where the IRS says the exchanges have to track basis. They're already doing a horrible job at it. Different story. But, it is dangerous, because that's going to cause even more of issues, because the IRS, again, I've seen incorrect 1099s from Morgan Stanley and Charles Schwab, where we knew it was wrong. And we contacted the IRS for my clients, and the IRS said, well, you have to take it up with them. And then we had to, because we believe what they gave us. So then we have to go to this whole disaster. Have you ever tried calling Coinbase? You ever tried calling Kraken? Good luck. How are you going to get it fixed?
It's about the same as calling the IRS.
No. Well, actually, it's easier to get a hold of the IRS than it is to call Coinbase. Yeah.
That's too funny.
Yeah.
But as you're talking about all these different things, the variance in numbers that you discovered surprised me a lot. 35% ish minimum between platforms on identical data. for someone who's never done crypto taxes, help them understand what this actually means in real dollars and real audit risk. And then we can talk about the calculation of like how you got there.
Let's look at it just a test. And I just did this for every year, but let's just take 2024. I had an exchange and there were about 70 transactions. Again, they're all testing transactions, right? And the exchange itself does the tax calculations. And they told me, you have $99 worth of gain. Great. A lot of them were self-transfers, but I didn't worry about that because, again, I have all these other wallets. And so I buy on the exchange and I just send it there. So technically I don't have the gain, but let's just say, yep, $99 worth of gains. Now, this exchange is a shareholder and investor in two of the top products on the market, crypto tax products on the market. And they endorse them. And of course, they make money if they make money and probably kickbacks and referral bonuses, et cetera, et cetera. Great. So I went to the two products endorsed by this exchange. Now, your assumption would be that if they're partnered up, if they're in that, they should have the same algorithms going on there, right? There should have been some due diligence, some review, something. Okay, great. So I go to the first product and I put in this, I did the OAuth2, right? Connect straight to my exchange. So I connect straight via OAuth2 into that exchange. They pull the data and they tell me on the same set of data, I have a gain of $2,990. Same set of data, 70 transactions, buy, sell, send, where the exchange told me $99. So that's a big issue. It's a very big issue because one, if not 2,990 is right, I am underreporting if I take what the exchange tells me. Now we go to the second product that's endorsed and owned by them. I put the same set of data in again, pull it through OAuth2. I can't manipulate it. Tells me I have a loss of $351. So nowhere close. Gain of $29.90, loss of $351 on the crypto tax products, right? That say the IRS compliant and blah, 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 all that fun stuff. The implication would be, now this is only 70 transactions of maybe me buying $20 there, $50 there, sending, literally, I did not put a lot of money through it. Now imagine it's a large trader. I mean, it's somebody who buys a lot more, who trades, and that does things like that. The variance would be intense. Now let's add some zeros on this. Let's say it tells me I have $29,000 of gain, and the other one tells me I have $3,500 in loss. The other one tells me I have $990 of gain. Now, if I use the $990, but the $29,000 is right, I have $20,000 worth of capital gain. And in my case, it was short-term, right? If it's long-term, great. You had 20% short-term, 28 to 37% tax. So what am I supposed to, like, if I report the $99 or $990 and I miss $20,000, there's penalties, there's interest, and it's compounded, because they're not going to catch it right away. Maybe they'll catch it in 2, 3, 4 years. Ultimately, there's no statute of limitation if it's considered, tax evasion and you intentionally omitted it, et cetera. Then if I go and report the loss of $3,500 because we added some zeros, great, I can take $3,000 and now I saved on taxes because it lowered my taxable income by $3,000 and I didn't report $29,000. So now I'm looking at over $32,000 worth of taxable income that I didn't pay tax on. And that might not be the big deal for certain people, but it's certainly a big deal for our middle class, especially if it's 2, 3 years, 4 years, 5 years, 6 years out from when that happened. And how do you know which one is right? How do you go to the IRS and sit there and say, well, this is what Coinbase said. And I'll get to that part in a second. And I just said the name word. I am not learning. See, that's why I get in trouble a lot. Whatever. Well,
I mean, so one of the things that you did after finding these things, right, is that you sent it to the exchange and they did something.
Well, a few things
36 hours.
Well, so a few things happened. So in 23, before we actually met with the SEC, IRS, and congressional committees and their attorneys, in 23, when I had everything in order and I knew what all of them are doing wrong and I had all the data organized, I reached out to all the products that I audited and I reached out to the exchanges who endorsed these products. And I said, listen, I don't want any money because I didn't. I was like, I just want to give you the research because this is detrimental to your users and US taxpayers. And I think we want to all make sure that we're okay, right? And I was like, I just want to give you the research for free. The one major exchange, compliance officer read it, blocked me. I'm like, okay, great. All the other products were like, yeah, no thanks, we're good. One I met with their CEO and tax attorney, asked some questions about how they got this and they couldn't answer it. And then they tried to sell me their product. And I'm like, yeah, that's not why I'm here. And so that's after that, we met with the SEC and IRS, and you kind of hinted at it. We met first with the SEC FinHub division and the enforcement attorneys, and they said, oh, crap. They said, but we don't oversee it, so let us send you straight to the IRS and congressional committees. So we met with the directors for the crypto division of the IRS and also the chief counsel, et cetera, and went over our findings. By the way, 2 of the products on that list that failed miserably, the IRS had contracts with to try and integrate them into their system. They don't have those contracts any longer. But during our discussions and after we presented our findings, we said, so how do you do your audits? And they say, well, based on your research, we're doing them wrong. I'm like, oh, how do you do them? And so they explained. I said, yeah, that's very bad. And so they did stop the audits. Then they started sending out requests for informations and requests for proposals, which we responded to. Then they stopped and they went into contact with Chainalysis. Again, love-hate relationship, right? I mean, I admire what they've done. It's amazing, but still. So since then, we've worked with multiple different universities and, have been published. And so this April 2025, I finally had enough. And I said, you know what? Let's compile all the research we have for that one major exchange that endorses these 2 products and does it themselves wrong, and just give them a breakdown and say, hey, talk to us. And so our attorney sent out a long, detailed letter with all the proof, all the write-ups, nothing threatening. And less than 36 hours later, for the first time in 8 years, they updated their terms of services. If you didn't sign, by the way, by May, your account would have been shut down. The change of terms of services said no more class action lawsuits allowed. Arbitration is mandatory. And they took away all the liability for their own tax calculations and any third parties that they're ever endorsing you to. So I don't think they really much liked our letter. They haven't contacted us, obviously. But, I don't think they liked what we wrote and the proof we've given them, because that was a very quick response for a large company to rewrite their terms of services. Let me back up again. So in 23, after the IRS and SEC and nobody did anything, I did my little monthly, quarterly report pulling for all of these products. And I pulled it in September of 23, and I had pulled it last, I think, probably June of 2023. We had given them the, heads up that something is wrong with their products in January, February of 23. When I pulled it, I was like, what is happening? Because I reviewed my 22 and 21 and 2020 taxes again. I was like, why are they different? And so I pulled up previous reports that I pulled on the same set of data. Nothing changed. I mean, I can't go backwards and make transactions appear backwards, right? So they should have stayed the same, and they always stayed the same. And so when I pulled them, all of a sudden there was a 25% 25 to 35% variance. So they tried to make changes and fix their own mistakes. I would have given them the research for free and they could have done it in 2 seconds. But they did it and they're still not right. But now we have the issue. What is it? I get audited for 22. And I say, listen, I tried my best. And the IRS says, great, if you tried your best and you did report and we know you didn't have any other option because they were all wrong, but you tried your best, please pull the report and show us the report that you used for your 22 or 21 reporting. So you go to the website and you pull your report, you give it to them and they say, well, this doesn't match. You had more gains on here than you had on there. Or this doesn't match. So what are you supposed to do? Because it would have been so simple for them to send out an email. And we scoured our emails because we're signed up for newsletters and updates. We scoured our email for it. And it would have been so easy for all of the products to say, hey, the IRS made updates to the regulations, because they always do. So we had to make some changes. We would suggest that if there were some adjustments, please pull your reports again and go amend. And it wouldn't be a liability to them. It would be a liability to the individual, but at least they let them know. Now they didn't. And so thankfully it's all reported and been peer reviewed by the universities, because we have recordings of it all. We have screenshots, we have prints, we have everything.
You have the receipts.
I have the receipts. Yeah. So that's when I said, screw this. I'm done trying to rely on others. Again, my stubbornness. See, my COO says I shouldn't say stubborn. She said something that sounds nicer, but I call myself stubborn. So my stubbornness said, well, you know what? I'm just going to build it myself.
Focused and determined.
Exactly. Yeah. I like stubborn better. And so I was like, you know what? I'm just going to build my own. Again, easier said than done. But I said, I'm going to build my own because if nobody gets it right, considering there has been tens of millions of John Doe letters, or the John Doe letters return tens of millions of US taxpayers' names. And there's 10, 15 million active traders consistently out there. And probably 50 million people have touched crypto at one point or another. The damages to the individuals will be detrimental because, and that's what I said earlier, even if these products were right or close to right, they would still not be able to be used in an audit because of their features.
Support provided by Skyflow. What if you could build fast but not break privacy? What if you could ensure data privacy, governance, and compliance with just a few API calls? What if you could worry less about PCI requirements while actually improving privacy and security? How much more time would your team have to truly innovate? How much faster could you build and ship new features? How much more powerful could your app be? Skyflow is a zero-trust data privacy vault delivered as an API. Skyflow's radically simple design lets you collect, secure, and tokenize personal information like card data and payment details. And with built-in features like encrypted data analysis and sharing, anonymization, and advanced governance, your days of choosing between data security and data usability are over. Whether you're just concerned with PCI compliance or need to go further to include CCPA, GDPR, SOC 2, and beyond, Skyflow has you covered. What if you could build fast but not break privacy? With Skyflow, you can. Visit skyflowsecure.com today to learn how.
And one of the comparisons that you had made with me earlier is like between crypto tax platforms and QuickBooks. I really think was really brilliant and terrifying at the same time. But I want you to help the audience understand it a little bit more. So explain why the IRS asks for bank statements in an audit, but never will ask for your QuickBooks, and how this same principle destroys the credibility of some of the crypto tax platforms.
Yeah. So let's say you're a business owner and you're being audited and you have QuickBooks where you keep your profit and loss and you categorize your transactions. The thing is, every book has to have adjusted journal entries at the end of the year just because taxes are being calculated differently than just your regular accounting. You can manipulate data. I mean, I can import my transactions, but I can delete it, or I can make up one. I can make it look like I made $15 million last year, even though I made $1,500. I can manipulate all the data. And that's not set up for it to be used for fraudulent purposes. It's just set up because we will pay things with cash, or we will use other means that might not be reflected on the bank statements, or it might not be reflected, like depreciation, things like that. They have to have adjusted journal entries, and that's fine. But the IRS also knows they can't rely on this. So when the IRS comes, they ask for receipts, and they ask for invoices, and they ask for bank statements, and they ask for it to match. Because bank statements, listen, the IRS has a problem. If you ever think about manipulating a PDF bank statements, don't do it. They have a program, they run it through, they tell them if it was manipulated. Don't do it. Been there, done that with a client before. I'm like, oh, crap. Don't do that. So they want the bank statements that come directly from the bank, with all the details. They want the official invoices, the titles for cars, etc. They don't want anything that can be manipulated. So the same with these products. There are issues with these products. And we go back to what I said earlier, how I created these wallets and ran test transactions to see how it comes over on an API. When I pull it from the blockchain, these products didn't do that. So they had to be able to let you, the user, categorize things. And that would have been fine if they let you categorize transactions as a self-transfer, things like that. But they took it even further. And I said this, I like this. What happens on the blockchain stays on the blockchain. I was just in Vegas, so, but what happens on the blockchain stays on the blockchain. We all know you send something, you do something, you cannot reverse it. Now, these products have features, and they're necessary because they don't know if they're pulling things right. And then they know they're not pulling things right. So they had to have a way to correct it, and they don't know how to. So you have to do it. But it all comes with the feature of editing a transaction. And I'm not saying like I'm making it a self-transfer or whatever. No. You can edit the date, time, currency. Let's say you sold Bitcoin. They allow you to change it to Ethereum, Solana, whatever you want. They allow you to change the basis, the spot price, the fees. Anything that is definitely set in stone, they allow you to change. And that alone will disqualify the product from you being able to use it in an audit.
So when you say these platforms allow the users to change currency types, dates, timestamps, fees, values, the basis, you're essentially saying they're allowing people to create their own reality. And how does DeFi Tax handle this differently? I'm hearing all these things and I'm like, all right, well, let's understand how it's supposed to be done.
Well, so ultimately, like I said, we've done a lot of trial and error on our own set of data. We have the amount of wallets we have and exchanges, and I have 15 more I actually have to set up, is absolutely insane. But we did it ourselves. So we know how it came over. So we know how to categorize it because we did all the different set of transactions, bought NFTs, sold NFTs, moved this, did trades, all of it. So we know how it comes over on the back end. So we know how to categorize it so that you don't have to, and we don't put that on you. Because first of all, you might not even know anymore what the heck you did back then. But second of all, we will never, ever allow you to change the basis or purchase price, spot price, fee of a transaction. It is all very, very prettily set up on the blockchain, okay? We have the dates and timestamps. We know how to get the basis if it's missing. We know how to trace it backwards for NFTs. We've built it all out that there's no need for you to do this. Now, we do allow you to categorize some of the transactions. For example, if you receive crypto, it's automatically income. However,
so what's the difference between categorizing versus manipulating? Like that's a piece that sounds similar.
Yeah. So there's different categories that trigger taxable events. So the categories are buy and sell, right? Then there's trade. There is transfer. There is send. There's receive. There's, staking. And those are all the types of things you can do on the blockchain that can trigger taxable events. The manipulation part, the editing of the transactions is you literally change the core of that transaction, whatever it is. If it was a trade, you can change it from Bitcoin to Ethereum, right? Those are the editing and manipulation of something that is set in stone. Now,
so what comes to mind also now is I think about like validator accounts and burn fees and all these other things. Like, how does that?
We're the only product that catches it. So we have people that have validator accounts and especially with validator accounts, if you even try to connect those addresses to any of the products, they come up with nothing, or they would come up with 5 failed transactions, not the tens of thousands that are actually on there. And one key aspect is a validator account would be considered income to the individual. But one key factor is there's burn fees. Some of the fees that they're receiving are actually burned in the process of this validation happening. And so we are actually able to subtract the burn fees to show the real amount of income that they have received due to the fees. So that
is that looked at the same way as a gas fee then?
Yeah, it's so on your end it's an expense, and on their end it's income to them, like ordinary income, not gain.
And I start to think about the NFTs as well, right? So, how should we be looking at tracing the basis, categorizing that properly? Because I know like some of the other platforms I've worked with require
for you to tell them
pretty substantial level of work to get it right.
Yeah, they require you to put in the basis if you did not purchase it yourself. So we actually found a way to trace the NFTs based on the type of NFT and trace it back to the source. So we know, for example, you receive an NFT from me and I received that NFT from a friend of mine, and that friend got it from somebody who actually bought it. So they bought it. Initially, it was bought for $5. Then it was sent to my friend and it was worth $10. So her basis in it is $10. She has $10 of ordinary income and $10 of basis in the NFT. So then she sends it to me and now it's worth $15. So now she has a $5 gain and I have an NFT with a basis of $15. And then I send it to you and now it's worth $20. I have $5 of gain and you have a $20 basis NFT. However, on the blockchain and on the other products, it doesn't show the basis of it. So we trace it back to the first time somebody actually purchased it. And then when they transferred it, we add the basis onto it, right? When it changed hands, we can calculate the basis based on the time of that currency, whatever the NFT is made out of that currency, based on how much it was worth at that time. So we can trace the NFT.
So now you got me quite, like, as you're talking about this and my mind's going, I'm like, all right, so does that mean that you're looking at what, like, where are you getting the rate for that spot moment in time? If you look at
on various sources, because everybody gets.
Is there any answer? I look at Kraken, I look at Coinbase, I get three completely different values for a coin. Like, how
So
do you choose the least expensive one, most expensive
we take
one?
the average. We take three different, we take three different sources and we get the average of it at the time and date. And that is the most accurate. And listen, some of the products, they report the basis at what they sold it to you for. And that's great. Then we have it. But for anything that we haven't, we take the average at the date and time stamp and we take off of the sources that we can go with. But we take three sources and we take the average of it. And so that's all in the algorithms, right? It's all in the back end. And we keep track of the sources too. We show if the IRS should audit you, we can give them all the details as to why we got to this and how we use that. Because if they only use one source, we can say, that's an easy, if we go to tax court, we say, we used three sources and took the average. They only used one. Ours is much better than yours. It's just so, we have built it in a way, let's go back to the categorization. So if you just, let's say you connect one of your wallets, you didn't connect the other two because you don't remember the address anymore. You can't get to them. You lost it and you have nothing in there, but you used them at one point or another. So let's say there is something that you sent to the wallet you connected. And you say, oh, wait, this is an income. I actually sent this from my other wallet. I don't remember that wallet, but I'm going to categorize it as a self-transfer. So a self-transfer would make that non-taxable. Problem is, people can lie. So I don't just let you go and say self-transfer in order to get rid of the taxable component of it. You say self-transfer and we say, okay, public blockchain, private blockchain, exchange or public blockchain wallet or, anything. You say, oh, it's a public blockchain. We say, great. We're going to pull it and add it to your account automatically. So you can't now, if you lie to us, now you have a whole nother wallet attached to your calculations. And if you didn't lie, we just found your missing wallet and attached it. And now everything that came from there is no longer income producing. And now we have the accurate basis for you as well, because your basis is what you purchased it for in your other wallet, not the basis and what it came over. So we match it all. Yeah. Now, if you lie to us, no, you have another wallet attached. You might not want that because you don't know what's happening there. But that's your prerogative. If you want to pay more tax, go for it. And then if it is an exchange, unfortunately, because it's a private blockchain, we can't just hold the data. So we'll, be like, okay, listen, you have to connect to it. You have to find it. You have to connect to it. And we can help with finding ways to connect, especially if you lost it. People use Binance US. They can't use it anymore. So we're working on that so people can actually get their data over. And then again, you have an option, and that's in the other products, to say, look, I gifted this to my friend. And that's fine. You can gift all you want. But if you select gift, we're going to ask you for some info. We're going to say, hey, are you married or single? Because it changes the threshold, right? Then we say, okay, well, give us the info of your friend, because that way you have it for record keeping. We allow you to upload, like if you say it was a donation, we allow you to upload to that transaction the donation receipt. So you have it always set up. If an audit happens, you have it all put together very nicely. And then we set up a bookkeeping version for businesses that they can add their receipts to it, their invoices, whatever it is, to show, but even emails, right? Let's say you send an email and you say, hey, you owe me 0.5 Bitcoin for the service I produced. Okay, great. Here you go. I'm going to add the screenshot of the email to that transaction. So you can keep records very cleanly that if you get audited and you hire us to handle your audit, which you definitely should, because we can sit in front of the IRS and manually calculate your transactions. Nobody else can that. And I can show my work, right? Like in math class. And I can show why they're wrong and I'm right. And then we have a full packet, right? And we can say, hey, here you go. Let's go argue back and forth a little bit, but we can do it manually. I've done it manually for 20,000 transactions across 3 different places. And I can show my work.
Well, I want to go back because you'd started to talk about something earlier that had some major implications, right? So there's something you discovered that actually should be pretty terrifying to anyone that's used one of the other platforms or one of the platforms that you audited and reviewed. And I want you to kind of tell me about the algorithm changes that you exposed. You'd mentioned, and maybe go a little bit deeper into how these major platforms tried to fix it, didn't tell you, didn't
as a user, didn't tell you as a user. Yeah. So
what does this mean for somebody who gets audited for 2021 or 2022?
I mean, listen, if in 21 and 22, you didn't report anything anyways, it doesn't really mean much, right? Because you didn't report. So, but again, even in an audit, these reports would be useless just because of the IRS. The government knows my research has been published, but it's not just been published on tax notes. The university actually sent the research before we removed the NDA that disallowed them from publishing it publicly. It first went to congressional committees and the government, right? So they know that all these products are inaccurate. They've known for a while, but now they know for sure.
So what happens, like, if I do get audited and my numbers come out to be a 35-ish, 40%, whatever the percentage is, difference from what it was before? Like, what actually happens in that audit?
Well, this is the thing. Let's say you get audited and you used any of the products, okay? And let's say the IRS, something gets pushed through and the IRS says, okay, listen, anybody who tried and used one of those products, right? You're not going to get the tax evasion penalties. You're not going to get the under-reporting penalties and things like that. You're still going to get the late payment penalties. You're still going to get your interest, but you're not going to get the substantial penalties that would really cause an issue. And I can see that happening, right? Because people tried. If you tried and if you followed what these reports gave you. So now you go to, and there's only one out of the 14 products that did not try to make changes. So those still match. But the other products all tried to make changes. And so what exactly they did, I didn't go down that rabbit hole again because I didn't want to. I just know it was different. And they didn't care about my opinion the last time. So I don't really care about giving them a solution this time. But I know, and I had multiple people double check it, people who use these products. I called another CPA firm I know and I said, hey, any of your clients who use that product, can you have them check? And it came back 25 to 35% difference for all of them. So the issue is this. Now, let's say you get audited and they say, okay, well, you tried to report. What did you use? Well, I used ABC. They say, okay, great. Give us the report. Now, hopefully the original report is still available to them. If it's 3-4 years, some people might not have it anymore. And they go in and pull it themselves again. And they show it to them and they say, hey, yeah, here's the report. And the IRS says, and it could be good or bad, right? So let's say your 25 to 35% went down on that report. And they say, oh, well, you overreported. Fools. Good. Doesn't mean that the IRS says you overreported after they do the math, but you're not going to get in trouble for underreporting. Well, let's say it went the other way. That's where the issue starts, right? Then you say, well, but that's what they said. Well, prove it. Prove that that's what they said. Prove that they made the changes, right? So it can be the difference between having the substantial penalties attached, be you audit or not. And listen, based on the IRS math, based on my math, since crypto has become a thing, let's say from 2009 until, let's just say, and this was my calculation back in 2023, the IRS probably missed out on about $146 billion in capital gains tax and ordinary income tax. They're going to go find us somehow.
They will. We've come to my favorite part of the show. So really, everything we talked about is just, it really expresses like how the crypto tax landscape has changed dramatically just over the last 5 years, really. And you've actually had this front row seat to what has happened and kind of get to see what's in the works as we talk about. Mm-hmm. But what I want you to do is I want you to take a look into my crystal ball. I want you to look deep into the crystal ball.
I'm trying.
And tell me what you see in the next 3 to 5 years when it comes to crypto tax compliance, enforcement, and what is it that you're seeing?
And I don't want to make this political. It's just, something that's been happening over and over. Republicans are in office, IRS shrinks. Democrats are in office, IRS goes up, tax breaks disappear, etc. Considering that the 1099 DAs that I really don't like were in discussions, and then President Trump came into office, he got rid of them. So my assumption is that, either during Trump's presidency or right after, that's going to be a major thing that's going to be implemented again for 1099 DAs, which is going to be detrimental. It's going to be a mess. Now, and I can be very cocky. I can say, well, it won't be a mess if these exchanges would use my freaking algorithms, because then they could actually trace right. So that would be a good solution. And again, I didn't do this to make money. I tried to give this away for free multiple times. People didn't care. I just don't want the damages that can happen. And that brings us to the next thing. So enforcement is going to happen. My gut feeling is the audits are going to start within the next 6 to 18 months. The audits are going to be in full swing. They're going to start with high-income earners first and then work their way down. Now, the good thing is high-income earners, they're going to have the money to get representation and hopefully go in front of tax court and get some precedent set that hopefully will help our middle class once it hits them. However, if we look at our middle class, let's say they made some money in 2019 and they made some money in 24, not a lot. Maybe they had $10,000, $15,000 in gains, right? Maybe 20, maybe more, but not a lot, but enough for them to be like, yay, right? So now let's say it was in 2019. Interest rate right now for compounding IRS is 8%. It's always been between 6, 7, 8%. And then the penalties. Let's imagine they probably didn't report because 2019, who knew about it? Nobody reported. The little box on your return didn't pop up until 2021. But now you're under audit for all the years, not just 2019, 2020, because there's no statute of limitation if they consider it tax evasion. And that's what I'm talking about precedent. I'm going to hope that somebody sets a precedent that it shouldn't be considered tax evasion. We'll see. If it doesn't, the middle class is going to look at $20,000 capital gains. Let's say, hopefully it was long-term. That's only $4,000, not with the interest and the penalties attached. You got to look at more like 10. We're gonna have the middle class they rely on their $2,000, $3,000, $4,000 refunds every year to whatever it is, fix their car, buy their kids clothes, go on a vacation. That's going to disappear until it is paid off. The slower you pay off, the more interest gets compounded, the more penalties get increased, et cetera, right? So it's something that they're going to be stuck in for 3, 4, 5 years before enough of their refunds are going to be taken. Those refunds are going to also be detrimental because they're not going to be put into our economy. So it's this snowball effect, right? That's what I'm seeing. So ultimately, my goal for this is to really get people to understand it. And listen, if I could scream from the rooftops and say, can you just listen, and somebody would, that would be amazing. But none of the products are going to admit that they've done it wrong. None of the exchanges are going to admit that they've done it wrong. The government, of course, is not going to admit that, hey, we should have let you know that these products are not good and maybe put something in place. So what are we going to do, right? So my only recourse is get the software going, hopefully get as many people. And that's what we're doing. We're giving out, we're donating 125 to 200,000 licenses for our product, for audit support this year. Because like I said, didn't do it for money. Want to get it out, want to get it. There's many CPA firms, accounting firms, because in our audits of the 53 so-called crypto tax expert firms, they simply asked for your data and ran it through a $100 program, but charged us $2,000 to $3,000 for our transactions and then gave it back to us. So again, there's no solution, right? So I've built one and I stand behind it, because if you get audited, we're a group of tax attorneys, EAs, CPAs. We can represent you all the way up to tax court. We will go and ensure that we prove to the IRS we're right and they're wrong. And we will negotiate and we will ensure that you get the best outcome that you can, as we've done this for years. And we'll fight because they knew, the products knew, they just didn't care because everybody just cared about making a quick buck.
Last question. If you were to give somebody who is not a crypto expert, not a digital assets expert, but is that digital asset curious person who may have bought $50 of Bitcoin, may have bought an NFT of their favorite thing, what advice would you give them? And yeah, let's go that.
If you in your lifetime have bought or held less than $20,000, I wouldn't be too worried about the audit. But what I advise anybody to do, and because that's one of the big things I have going on right now, because we help a lot of our users trace because they forget which wallet they had, what they had. I have so many wallets right now. If I didn't have a spreadsheet, I wouldn't know what to do with it. But keep track of your wallet addresses and logins, even for the exchanges that are now discontinued in the US, because we can still get into them. Not into them like we can do trades, but into them through the back end to pull your data. Because the key is that we have all of your data. You want to have a full picture. If you don't have all of your data, the same thing that happens with the 1099 DAs is happening, right? If you transfer things from other wallets and you no longer have access to it or you can't find it, and you only give them this one set, they're going to say, oh, look, this was all income. Let's say you transferred $100,000 Bitcoin from one to the next one, and you just let it sit in the new exchange wallet, wherever you had it, and you only have that. They're going to say that's $100,000 worth of income, even though it wasn't. It was your own, right? So you want to ensure that you make a list, not necessarily the private keys. We don't care about those. I care about the public wallet addresses and your logins to your exchanges. Track it. It is only so scary right now because they're going back and nobody is organized. That's why we built something that keeps you organized and will help you trace it, will help you connect it, will help you get to where you need to go. And like I said, we will pull it automatically. If you know for sure, oh, this is definitely a self-transfer, we can connect it, just not on an exchange because exchanges work differently.
So how would you say that in one sentence?
Oh God, keep track of your addresses and wallets and exchanges and logins. That's it.
How important is it to make sure that each movement is categorized properly?
Like I just said, one differentiating factor can cost you $100,000 in additional taxable income or $50,000 to $100,000 in additional capital gain, which is significant, at the tax rates.
Jana, every time that I talk to you, it's like this eye-opening experience for me on so many different levels. Let me do just a quick recap of what we've talked about today. One, the crypto tax platform industry has been broken, and you're bringing DeFi Tax in to really solve that fundamental flaw. What people think keeps them safe from these audits, using popular platforms and all this stuff, just gives them a little bit of exposure that maybe they weren't expecting, and really in some cases could be inadmissible as evidence to prove it. And the other thing that I think I took away from this too is that it's important to be working with groups that have a collaborative approach, that are working with the IRS, the SEC, and other agencies to really support you, and not just come from the perspective of move fast and break things, but more from the perspective of be diligent and be thoughtful in your movements so that you don't end up in the audit situation. And honestly, we're at this cusp of a massive shift in crypto tax enforcement, because it has become more mainstream and most people aren't prepared for it. Jana, before we wrap up, for someone who's listening, who's used one of the traditional crypto tax platforms, and after listening to this has decided I'm panicking, what's the right thing that they should do right away?
So collect all your addresses, collect all your logins for exchanges, even the ones that might not exist anymore, and then go and look us up at defitax.us. We are giving out free subscriptions right now because my goal is, again, to get people into as many secure positions as possible. The goal was never to make money. And that's, I guess, my biggest anger with these companies, with my competitors now, is they're literally valued at billions of dollars. They have the resources to fix it, yet they have not. They haven't done anything since April, since we sent out the letters. Nothing has been changed. And so it's just disappointing because, and I would be especially disappointed if I was I am somebody that paid them for the subscription, but if I was somebody that paid even more and you sit there and you just wasted so much of your money, which I mean might be one reason because they don't want to be liable. But they have the resources to do it, to do something quicker, to do something right, and they're not, So ensure that you have everything, all the addresses, all the exchanges, keep track of them, and then you can go visit us at defitax.us. And you can sign up right now for free for the highest level that goes down into the token level and get going and go back for all of the years that you've had it.
Jana, thank you for not only just sharing your expertise, but your unvarnished perspective on where this industry really stands. And as Jana mentioned, for anyone who wants to join the DeFi Tax, I think it's a wait list still, is it not?
No, it's open and ready to use.
All right. Well, if you want to join and start using DeFi Tax, you can head right over to defitax.us and go ahead and sign up for it. And well, that's it for today's episode of Web3 with FTC. If this discussion caught your attention, there's a lot more ahead. So go ahead and hit follow on YouTube, Spotify, Apple Podcasts, or wherever you listen. To stay plugged into everything happening here at Fintech Confidential, go ahead and head over to fintechconfidential.com and sign up there as well. That's where you're going to get all the deep dives, the details on future episodes. And be sure to share this with someone who's serious about where Fintech's going. And as always, keep moving forward.
As we wrap up today's episode, I've got one last thing for you. If you're in the trenches fighting fraud and financial crime, you know it's a complex battlefield. That's where Hawk's AI tools for real-time payment screening, AML, transaction monitoring, and dynamic customer risk rating come into play. These aren't just buzzwords, they're game changers designed to make your compliance more effective and less of a headache. Imagine slashing through false positives with precision and giving your compliance strategy the edge it needs. Head on over to gethawkai.com to sign up for a demo and discover how their platform can revolutionize how you fight fraud and financial crime.
This has been a production of DD3 Media, with all rights reserved. This is provided for informational purposes only. It is not offered or intended to be used as legal, tax, investment, financial, or other advice. We strive to provide accurate and up-to-date information, but will not be responsible for any missing facts or inaccurate information. You comply and understand that you should use any of this information at your own risk. Cryptocurrencies are highly volatile financial assets, so research and make your own financial decisions.